Hello everyone, I'm Vincent Andreacchi, VP of Business Development at ISG Transportation, and I'd like to share a brief February 2026 update on the North American LTL and full truckload markets. As we progress through the early months of 2026, freight demand has remained steady, but seasonally subdued, with volumes showing little deviation from recent trends. However, extreme weather events across North America have exacerbated capacity struggles, leading to widespread disruptions. Carriers are running exceptionally lean on equipment and drivers, compounding delays in a market where volumes may not surge, but are consistent enough to strain networks. Experienced drivers are hard to find, and immigration restrictions continue to put pressure on the driver supply. Pricing is facing upward pressures as carriers are in financial hardship and push for profitability after years of operating at razor-thin levels. This dynamic is impacting high-volume lanes, including southbound freight in critical areas. Overall, spot and contract rates have shown increases of 15 to 25% year over year in many segments, with some short-term spikes tied to weather disruptions. The Canadian trucking market continues to exhibit relative balance compared to the US, but weather-related challenges are introducing more variability. Domestic truckload tender rejection rates have ticked up slightly to around 5 to 8%, reflecting intermittent tightness driven by winter storms and equipment constraints. Drivers are opting for safer routes to the US when many road closures exist in Canada. LTL volumes have held steady, supported by retail and industrial activity in provinces like Ontario and Quebec. Full truckload conditions show signs of stabilization amid lower diesel prices, averaging about 1.45 Canadian per liter. However, extreme cold and snow in Western Canada have led to delays, particularly in lanes like Calgary to Edmonton and Vancouver to Toronto. Rates remain flat to modestly higher year over year. With spot contract gap narrowing, ongoing risks include fuel price fluctuations, driver shortages, and infrastructure strain from weather. But long-term trade initiatives with Canada could support gradual recovery. Cross-border freight between the US and Canada is experiencing uneven conditions, influenced by automotive softness, tariff adjustments, customs processing delays, and severe winter weather disruptions. Northbound freight from the US into Canada remains steady in terms of demand, with less downward pressure on rates. This is supported by non-automotive exports like consumer goods, industrial products, and electronics. Tender rejection rates are around 8 to 10%, with rates holding steady despite short-term weather-induced tightness from storms like Winter Storm Fern. Southbound freight into the US is facing more pronounced struggles, with reduced volumes in automotive and parts leading to equipment imbalances and competitive pricing pressures. We've seen this particularly affect key areas like Toronto, Chicago, Windsor, Detroit, Ontario, Tennessee, where rejection rates are lower at 3 to 5%, but delays are compounded by thin carrier operations, weather events, and more pre-planning with a strategic northbound shipment. Nearshoring trends continue to underpin long-term growth, but near-term volatility from policy uncertainty and seasonal factors still persist. The US domestic truckload market is showing clear signs of tightening, intensified by extreme winter weather and persistent capacity constraints. National tender rejection rates are notably elevated, with dry van around 13 to 14%, reefer nearing 20%, and flatbed up to 24% in recent data. But figures have pushed higher by storm-related disruptions. Spot rates have held firm with meaningful year-over-year gains, often 20% plus in key segments, and the spot contract gap is closing. This sets the stage for stronger 2026 contract renewals. Forecasts are pointing to mid-single-digit to low double-digit percentage increases, depending on the mode. LTL volumes remain soft, but are stabilizing, with carriers implementing disciplined rate adjustments as freight shifts toward truckload amid tightening conditions. While shipment volumes are down modestly year over year, freight spend indicators are firming, highlighting a market driven primarily by supply-side pressures rather than broad demand recovery. Let's talk about some key trends that we're seeing in the marketplace. Trend number 1, gradual capacity tightening and lingering supply issues. Extreme winter weather has amplified delays and strains, but as conditions moderate, carriers remain lean on equipment and drivers after years of low margins. This keeps capacity fragile. Tender rejections are elevated, and even small volume upticks could compound these issues. Shippers, focus on building in buffer time. Vet your carriers, ensure that they can support your business financially and from an availability perspective, And monitor rejection rates closely for early signs of further tightening. Prioritize reliable partners over chasing the lowest rates. Second trend, upward pricing pressure and tougher renewals. Spot and contracted rates are firming, with year-over-year gains of 15 to 30% in many segments as carriers recover margin. Forecasts point to mid-single-digit to low double-digit increases in 2026, driven by supply-side constraints rather than a demand surge. Drivers are demanding higher wages with a 5 to 6% wage increase, and immigration restrictions will continue to strain the market. Focus on locking in agreements early where possible, and use data from indicators like ours to negotiate effectively. Rates have bottomed and they're trending higher. Trend number 3, potential for sharp shifts from policy or volume changes. Demand is steady, but it's still soft. Yet policy adjustments like tariff resolutions, stimulus, or nearshoring boosts could spark a quick volume rise, which would lead to rapid shortages and rate spikes, especially if cross-border or US domestic flows pick up. Focus on planning for 10 to 20% volume increases and how freight spikes may impact those movements. I personally see current tightness as mostly temporary, with easing likely in spring, but stay agile with diversified options and real-time visibility tools. Prepare for moderation with upside risks. Focus on resilience, strong relationships, and be proactive, planning to stay ahead. Freight demand across North America is steady but subdued, yet capacity conditions are increasingly strained due to extreme weather, lean carrier operations, and equipment driver shortages. The early 2026 market feels uneven and highly sensitive to disruptions, with notable ripple effects on many major corridors. Should volumes increase from policy changes, such as tariff resolutions, economic stimulus, or other adjustments, we could see a sharp market shift with rapid capacity shortages and significant rate escalation. That said, I personally view the current tightness as temporary, largely fueled by weather events and transitional factors rather than a permanent structural change. Maintain flexibility by building strong carrier partnerships, and planning proactively with contingencies will be critical to managing these dynamics effectively. As always, feel free to reach out to any of the members of our sales team, and we will be happy to discuss how these developments might affect your supply chain.